afternoon to all of you, and welcome to the Darla Moore School of Business 2020 Economic Outlook webinar. My name is Jan Bass, and I am the Associate Dean of Undergraduate Programs and Professor of Economics, and I will be the moderator today. As moderator, I wanted to cover a few procedures for the event. First, please know that the event will be recorded. Second, there will be a Q&A after our three panelists conclude their presentations. If the Q&A runs over time, we will stay to answer your questions. Third, in the webinar format, if you would like to ask a question, please send all questions to me, the moderator, through the chat function. In your question, if there is a specific panelist that you would like your question to go to, please put the panelist name at the beginning of your question. That way I will know who to direct your question to. Finally, I will be monitoring chat for questions and will fold similar questions into one to save time. So for now, I will turn it over to our Dean, Pete Bruce.
Thank you, Jan, for that introduction. And ladies and gentlemen, welcome to our 40th Economic Outlook Conference. It really is amazing when you think that we've been doing this now for 4 decades. We have over 200 people registered, and because we are live streaming from all over the country, which is really, really cool. We do have a number of our BPF trustees with us. We have a chancellor, a couple of deans. We have many business owners, presidents, CEOs, chairmen and women, directors, GMs, SVPs, and many public administrators. And of course, faculty, staff, and students of the Moore School at this event. I also wanted to thank at this point the SCRA and Blue Cross Blue Shield of South Carolina for their sponsorship, and just say that without their support, we would not have been able to do this to the degree that we do this event every year. That's enough from me. I just wanted to mention that our next conference of this series is on November the 30th. Again, it is virtual. And what this does is it makes it available to anybody, anywhere. So please tell your friends, get them to come in and join us. And we obviously look forward to hosting our fall 2021 conference, hopefully in person, but I think we're probably going to continue to do it virtually too, so that we can reach a wider audience. Thank you to Doug and to Joey for setting this up. And of course, it's now my honor and distinct pleasure to introduce Bob Oldendick, who is a professor of political science and director of graduate studies at the University of South Carolina's College of Arts and Sciences. Bob, I must tell you that your boss, Lacey Ford, is watching, so you'd best do well. Good luck, Bob. He's going to be telling us about who's going to win the election in a month's time. He told me he knew, and then we will hear from our economists after that. All yours, Bob.
Okay, thank you, Peter. What I'm going to be speaking about today is obviously the election, and we're going to be talking about the presidential election. We're going to be looking at the some of the Senate election, and we're also going to look a little bit at the what's going on with the House of Representatives. And what we want to do is fortunately look at the presidential election. The polls that came out over the weekend showed that nationally that Joe Biden is ahead of Donald Trump by about 10 percentage points in most of the polls. But we know that this is not a national election. And what we understanding is that these are really, this is 51 separate elections in which the candidates are vying for the seats in the Electoral College in the 50 states in the District of Columbia. And so there is this rush to get to these 270 Electoral College votes. And we know that there are 18 states plus the District of Columbia that are reliably Democratic votes and provide Joe Biden with 219 electoral votes as his base. There are 20 states that are reliably Republican, provide Donald Trump with 126 electoral votes. And then there are these 12 potential toss-up or battleground states. And these are the battleground states all the way from Michigan to Iowa. These are the 12 states. And those numbers there are the number of electoral votes. And what I'd like to do in the next couple of slides is based on what we know or what we think is going on with the polling and what's likely to happen in these states, kind of allocate these states to Biden or to Trump in the Electoral College. We'll start out with the ones I'm most confident in. The two states that I think are definitely going to go to Biden, Michigan and New Hampshire, while on the Trump side, the states of Florida, Arizona, Georgia, Ohio, Texas, and Iowa are probably going in that direction. So if we allocate those in that way, this first pass then takes the Electoral College to 244 for Trump and 239 for Biden, leaving us with Minnesota, Pennsylvania, North Carolina, and Wisconsin. Of these four states, I believe that Pennsylvania and Minnesota will be captured by Biden, and that Wisconsin will go to Donald Trump. And if that's the case, that would take Joe Biden to 269 electoral votes, Donald Trump with 254, which leaves us with North Carolina. And North Carolina is really, of all these states, everybody believes the closest state. All the polls show about a 1 percentage point advantage to one candidate or the other, or it's tied. But in the end, I think much like what happened in 2016, North Carolina will go to Donald Trump, which would result in a 269 to 269 tie in the Electoral College, in which case the election would be decided by the House of Representatives in January. Now, this is not really all that unrealistic of a scenario. These states are kind of all toss-up states, and it's quite possible that this could break in this way, which kind of underlies the uncertainty in the presidential election. Now, we could do different scenarios. Obviously, these being battleground or toss-up states, they could break for either candidate. If we take, for example, that Joe Biden is able to capture Florida and win those 29 electoral votes, that could be offset on the Donald Trump side by capturing Minnesota and Pennsylvania, getting those 30 electoral votes, which would make it 270 to 268 in favor of Trump. Or we could do another scenario. It says that Trump captures Pennsylvania, gaining those electoral votes, which Biden could offset by winning Arizona and Wisconsin, giving him the 270 to 268 victory. We can, with this number of battleground states up for grabs, you can do different scenarios, and there's all different kinds of permutations and combinations. But I think what all these exercises show is that it's going to be very close. And again, a great deal of uncertainty at the presidential level, underscored by the perceived closeness of the Electoral College vote. So that takes us to, okay, the presidential election is up for grabs, but what about the Senate? And so we're going to take a look real briefly at the Senate. Current composition of the Senate, there's 53 Republicans, 45 Democrats, and 2 independents who caucus with the Democrats, so a 53-47 split. In the current election, 35 of these seats are up for grabs. 23 are currently held by Republicans, 12 are held by Democrats. So in order for the Democrats to become a majority party in the Senate, they would have to get a net gain of 4 seats. And we recognize that in Alabama, the outlook really is that the Democrats are going to lose the seat that's currently held by Doug Jones, meaning that the Democrats would have to capture 5 seats in these toss-up races in order to gain a majority. And if we look at what I believe are the 5 closest races for the Senate, they're in Arizona, Colorado, Maine, Montana, and North Carolina. Each of these states is currently held by an incumbent Republican. You've got Martha McSally in Arizona, Cory Gardner in Colorado, Susan Collins in Maine, Steve Daines in Montana, and Tom Tillis in North Carolina. And the polling, again, in each of these states is very close. And given the closeness of these races, is it possible that one party or the other could sweep all these, giving the Republicans a much larger majority in the Senate, or enabling the Democrats to take all 5 seats and gaining a majority? Certainly, given the uncertainty that we have, that either of those outcomes is possible. What I think what will happen more likely, though, is that there will be a split, that Mark Kelly will prevail in Arizona, that Sarah Gideon will take the seat in Maine, and that Cal Cunningham will win in North Carolina, meaning that that would be a net gain of 2 seats for the Democrats, taking the Republican majority as we go into 2021, to 51 to 49. Now, given that we are in South Carolina, the obvious question would be, well, shouldn't the Lindsey Graham, Jamie Harrison race be on that list? And you're absolutely correct, it should be. In fact, the national kind of forecasters that look at this have made this pretty much of a toss-up race. And there are a couple things that I want to look a little more closely at this particular race, because there are two pieces of evidence that go in opposite directions that make this race very difficult to call. One is electoral history. If you look at the Senator Graham's previous races, in 2002, when he was first elected to the Senate, going against Alex Sanders, he won with 55% of the vote. And then his two re-election bids, he won with roughly 58% in each of those elections. And we have this electoral history in South Carolina. I like to refer to it often as a 55-45 state for the Republicans, because if you go back to 2018 and you look at the major statewide races, whether for governor or attorney general, the Secretary of State race, all those races were pretty close to 55 to 45 races, in one case getting up to close to 57, 58%. So that in terms of statewide races, Republicans have a natural advantage. So what makes this race so close? And that's the other piece of evidence we need to look at, and that is the fundraising totals. Because in the previous races, Senator Graham was able to far outspend his opponents. In 2002, it was about a 2-to-1 advantage that he had, well outspending his opponents in 2008 and 2014. But that's not the case in 2020. The latest figures from the Federal Election Commission show that both of these races, or both of these campaigns, have been able to raise about $30 million. And we know that in August, Jamie Harrison had a very good fundraising month, was able to raise about $10 million in August alone. And so in terms of the fundraising battle and the ability to compete, Jamie Harrison is in a much better position than any of the previous three races. So what's going to be the deciding factor, or what do I look at and say, well, why would we put this in one column or the other? And for me, it's the presidential race. We believe that in this state, Donald Trump will probably take the presidential vote by 8 to 10 percentage points, which means that 4 or 5% of the people would have to split their vote and vote for Donald Trump for president, and then vote for Jamie Harrison for Senate, or even a larger percentage if it's voting for Trump and then not voting in the Senate. And in looking at the data, it's very difficult for me to find where those voters come from. That there are some of them perhaps that are upset with Lindsey Graham for one reason or another and are not going to vote for him. But for them to vote for Donald Trump and then to switch their votes in the Senate race, I just haven't been able to find that group, which would lead me to put that check mark in the box for Jamie Harrison. So if we're going to make the outlook as of today, I would say that Senator Graham will be victorious in a very, very close vote. Just briefly to touch on the House of Representatives, again, all 435 seats are up. The Democrats hold a margin of 236 to 119. The Republicans would have to take 19 seats in order to regain the majority. Given what we know historically, what happens when presidents are running for a second term, there's not a lot of turnover in the House of Representatives. So of these three races, of the presidential, the Senate and the House of Representatives, there's the least uncertainty in the House of Representatives. I think it's fairly likely that the Democrats will be able to maintain their majority in the House of Representatives as we go into 2021. But for the other races, there is a great deal of uncertainty, which is kind of the theme of the 2020 election. So with that, I will turn it over to Jody.
Good afternoon, everyone. This is Doug Woodward. I'm the director of the Division of Research and professor of economics here at the Moore School. I've been running the Economic Outlook Conference live. As many of you know, and many of you have attended, usually we have this in late November, early December, but we thought it'd be very important, given all the uncertainty in the economy, to have an outlook, a pre-election outlook conference this year. Now we're gonna have a post-election outlook conference with Richmond Fed president coming in to speak in November. But thanks to Bob Oldendick for giving us the outlook on politics. It's very important that we understand what's happening with the political situation, because that's going to determine what's going to happen with the economic outlook, as I'll explain in my remarks. I'll be talking about what's going on at the national level with the economy. So much is happening, as everybody knows, since the shutdown in March, which is unprecedented, the COVID crisis. And the question I often get, more than any other as an economist, is what's going on with this disconnect between what's happening on Main Street and what's happening on Wall Street. Main Street is our metaphor for the real economy, for jobs and for income, for gross domestic product and growth. And what's happening, the outlook is usually what we focus on there. But there's also the financial markets. That's Wall Street, the metaphor we use for the financial markets. I want to address this very important question. So in the 15 minutes I have right now, I've got a lot to cover. After my remarks, we'll have the South Carolina outlook with Dr. Joey Von Nessen. Well, let's go back to where we started. Remember the Great Recession, a little over 10 years ago, that happened in 2007 through 2009. We thought that was the worst we would ever see in our lifetime. But then we had this great expansion from 2009 to early 2020. During that time, and this goes back to our Outlook conference last November or in early December, we predicted that this would be a pretty good year. The economy would slow down. But at the end of the Great Expansion, during this roughly 10 years, we finally reached the point of full employment. I had never seen an economy doing so well here in South Carolina or across the nation. We had 3.5% unemployment rate nationally, less than that, below 3% in South Carolina. So we really have full employment. And the big worry, just going back to January 2020, was we had a tight labor market, and where were employers going to find workers? That was the big challenge. So see how much things have changed. One thing that was happening by the end of this expansion was we were seeing real wages rise, even for low income workers. Everybody was benefiting during this expansion. We had a really good economy, better than anything we'd ever seen before. So here we are in late 2020, going into 2021. I want to talk about the US economic outlook at the time we're in right now. And it's also an election season. And the reason I brought in Professor Oldendick, Bob Oldendick, to talk about the election is because it's so crucial right now to understanding the economic outlook, because government policy, Washington, federal policy, is more important than it's ever been. And that has to do with this unprecedented monetary expansion that we've seen since March, and also the huge amount of government spending, which we call fiscal policy. I'm going to be addressing that. So I'm going to be talking about government policy and also about this disconnect between Wall Street and Main Street. I like to call what happened in March and in April the Great Suppression. It was such a shock. Never before in the US or around the world had governments consciously shut down the economy. We call this in economics an exogenous shock. It came completely outside from the economy and the financial markets. And then as a result of that, we had many different kinds of experiments during this lockdown or shutdown. Some shut down more than others. This is true around the world. It was true among different states. So we've had all these different experiments going on, and we're still in the middle of this period of experimenting with now opening up the economy again to see what would happen. But never before did we have suppression. We've had recessions, but we've never had suppressions, conscious suppressions. And the economy does not work well with social distancing, as we're all learning. Now, we're adjusting to that, but we've never seen anything like this before. We're trying to get an economy functioning. At the same time, we're mandating social distancing. This is causing tremendous uncertainty in the financial markets and in the real economy. I like to say that we're now in a period where the abnormal is the new normal. And I'm going to talk about what is really abnormal about the time we're living in from an economic point of view in this great suppression. We often hear about what is the shape of the recovery. We've had the suppression, now we're in a recovery, hopefully. People want to know, is this going to be quick? Is it going to be V-shaped? Is it going to be U-shaped? Well, it depends. With Wall Street and the financial markets, we've already seen it's been V-shaped. It's been a victory for Wall Street. The problem is now Wall Street has gotten out ahead of the real economy, out ahead of Main Street. I would argue that it's overvalued, and I'm going to come back to that during my remarks. Meanwhile, on Main Street, with everything closed during the coronavirus, it's going to be much more difficult to see a V-shaped recovery going forward. It's going to be wobbly. I call it W-shaped, W for wobbly. We're going to have rolling crises, both nationally, and as Dr. Van Neschen will be talking about, that's going to be true in South Carolina. But what we've got is Washington to the rescue. That's why I brought Bob in here, because what happens in Washington really is going to determine the trajectory of the economy. We have had, since March and April, unprecedented stimulus coming out of Washington, coming from the federal government. This is highly unusual in scale and in scope. We have never, ever seen anything like this before. And what's also very unusual about this is that it was bipartisan. Remember back in March and April, we had overwhelming support. I think there's only one vote against the stimulus package. I don't think that's going to happen again, especially if we get into this contested election and maybe even after the election, if there's not a clear outcome. So we're in a much more difficult position going forward to rely on Washington to rescue the economy as it did with this unprecedented stimulus going back to April and March. Here's the massive, we call fiscal stimulus, government spending that took place starting in mid-spring. $2.3 trillion, that's the CARE Act. Trillions of dollars. We've had stimulus before in the billions, but never in the trillions. In addition to the CARES Act, there was additional government spending that rose the national debt to $3 trillion just since the crisis began in spring. In addition to that, we've had the Federal Reserve, and I'm going to talk about that, expanding the money supply. That's the other form of stimulus. But this federal rescue, I would argue, has been very effective. It's boosted our real GDP. We'd be in a depression right now if it hadn't been for these trillions of dollars now coursing through our economy. It's holding our economy up. That's why politics is so crucial right now. In the second quarter of 2020, we had a precipitous decline in our gross domestic product. That's our measure of the overall production of goods and services in the economy. We've never seen anything like that. That's actually at an annual rate. If that had persisted, we'd have a 32% decline. Usually the economy is growing at roughly 3%, but we had a 32% decline at that time. That's the biggest ever. Then in the third quarter, we had this, we're anticipating, it just ended, but when the numbers come out, this is an estimate, a 32% increase. So it's been quite a roller coaster. Steep decline, now we're seeing the economy start to come back. I attribute a lot of this growth now that we're starting to see happen, that we saw happen over the last 3 months as a result of these federal policies, especially the CARES Act. So what we had is suppression, conscious suppression of the economy, went into a very rapid recession, with a very, very steep decline in employment and in GDP. And now we're in this tentative recovery. What's happening is we had a downward spiral from falling demand from the lockdown, leading to massive layoffs, much lower income, significantly lower income as a result of lower income, lower spending. We had business closures. And overall, we just had demand far below our potential supply. Just going back to last year, we had the supply to produce in this economy much more than is being demanded right now as a result of the suppression and then the ensuing recession. We predict right now that real GDP, as a result of all of these changes taking place, that's our best measure of the performance of the economy. That's the production of goods and services during a given period of time, a quarter or the year. But over the course of 2020, we expect real GDP will be likely 5% below where it was last year. And that is greater than what we saw in the Great Recession of 2007 to 2009. So in a very challenging time. One thing that's happening is consumer spending was really dropping. As you can see on the right-hand side of this chart, this is inflation-adjusted consumer expenditures. Consumer expenditures are roughly 67, 68% of overall GDP of our economy. So we depend on this, as we always have. Look at the left-hand, where I circled the left-hand side of this bar, and you can see in the Great Recession, we didn't see consumer spending going down that much. It went down a little bit, but nothing like we've seen now. It's recovered a lot, as you can see recently, looking at the right-hand side. Largely that's a result of the stimulus checks that were sent out to most Americans, the $1,200 plus more for families, the jobless benefits, the $600 in weekly benefits that were voted by bipartisan way that provided income relief and ultimately supported spending for our economy. Now that's over, that's expired in summer. We've got a $300 boost. That's been very helpful. But we are seeing consumer spending, even though it doesn't show up in the figures yet, starting to stall out in August. Consumers are starting to get much more cautious. And when that happens, we're in trouble because consumers are such a large segment of our overall economy. People are actually saving right now is in a precautionary mode. Now here's unemployment. This is why people are being cautious. We went from 3.5%, as I said before, in February, close to full employment as we could possibly get, shot up to 14.7% unemployment rate in April, and then rapidly back down to 8.4% unemployment in August. That's still very high. That's a recessionary level of an unemployment rate. Dr. Von National will be talking about what's happening in South Carolina in a few minutes, but that's where we are nationally right now, still with very high levels of unemployment, and that's going to persist, but it kind of depends on the nature of the next stimulus package that I'll be talking about coming from Washington. In terms of overall jobs, same thing. Unbelievable decline in the job base. 20 million jobs lost. We've never seen anything like this. It happened very rapidly. We've recovered about half of those, or roughly about 10 million jobs have come back as a result of the stimulus and the economy starting to open up, most of this since May. But that's so different than what we saw in the Great Recession, as you can see before. We lost lots of jobs back then, and it took a long time to recover them. That's what we called the jobless recovery for a while. It wasn't really till 2014 that we got back to the level we were before in overall jobs, total employment for the United States. What happened recently, as you can see on the right-hand side, is we dropped down to the level of employment that we were back in the depths of the Great Recession of 2009 and 2010. Now, we've recovered a lot of those. I worry, I want to emphasize this, that it isn't going to continue on this upward trajectory you see on the right-hand side. But that depends on a lot of factors, but especially what happens with the new government stimulus package. So the government's helped bring back a lot of the jobs. We've recovered a lot of those, but we still got a long ways to go. This is quite a different pattern than what we saw in the last recession. So let's do a reality check real quickly right here. We've got a real economy struggling. We got mainstream struggling. Right now, since August, we've got new jobless claims higher still than at the peak of the Great Recession. So we still got a lot of people out of work. Business failure still at an unprecedented level, still very high, more at risk of failure if the economy doesn't fully start functioning again. Because, as we all know, the pandemic is persisting. it's not over. This crisis isn't over, although it does seem to be over in China. They're opening up again and they're growing again. They're the only major economy where that's really happening. But the rest of the world is still facing the pandemic, and that's affecting the economy as we struggle to open up again. So we've got this real economy still in trouble, and yet the financial markets are exuberant. I don't know how the markets are doing today. The stock market's doing, yesterday had a great day. But what we're seeing is assets as opposed to production of goods and services. That's what we measure in GDP. But assets, which is a stock, like the stock market, are appreciating in a time of crisis. Never seen that before. In fact, wealthy Americans are in great shape. Sometimes Jeff Bezos or Elon Musk can make $4 billion to $5 billion in one day in wealth appreciation as a result of their ownership of stock. In fact, wealth is higher than it's ever been before in the United States. So income and jobs are hurting, but wealth is booming. And this is what a lot of people are questioning. Why is this the case? Well, one of the ways in which we've seen this wealth effect is in the housing market. And Dr. Von Nessen will be talking more about this. We've seen a lot of people demanding houses. They want to put their money into wealth. And that's in the major form of accumulating wealth in the United States is in a house. That's driven by this incredible structural shift to remote work and education. This home buying really started in May. It really started picking up a lot. You know, the spring home buying season wasn't possible because of social distancing. And then we started opening up and we started to see a huge growth in the demand for single family housing because people are shifting to remote work and they're putting their money into houses, which is a form of wealth. 1 million new housing sales in August, the highest since 2006, the peak of the housing boom at that time, up 43%, I'm sorry, from last year. And that's also fueling demand in some consumer spending and things like home improvement, exercise equipment. People aren't going to the gym, they're buying exercise equipment. They're buying electronics, computers, so they can work at home and other forms of durable goods. So some sectors of the economy are doing very well. But the part of the economy that is just off the charts is Wall Street. Now, at first, as you can see, this is the S&P 500. A lot of people follow this on a regular basis along with the Dow and other measures of market performance. But the standard measures is the S&P, and we were in a panic immediately after the shutdown. But it came back so quickly, as you can see, and reached the level of the S&P. In other words, the assets were priced at the same levels they were before the panic very quickly by mid-spring. And I think this was a surprise to everybody, and many people were very happy to see this. But we often hear, and this is something I hear from the public a lot, but of course the stock market is not the economy. Well, yes and no. It, in some sense, does reflect the economy. It reflects the future economy and the future ability of corporations to generate new earnings, and that depends on the real economy returning, but it's sort of anticipating the future. But really, why is this happening? We're back up to the level of stocks. They've appreciated to the same level that they were before the crisis, and that happened very, very quickly. We're almost in a euphoric period right now. So the question is the stock market overvalued? Well, according to Warren Buffett, it is, and I would encourage a lot of you to listen to his wisdom. He's 90 years old. He's been around a long time, been more successful than anybody else in playing the stock market, but he looks at the fundamentals, and he doesn't think, and I don't think either, the fundamentals support this overvalued stock market. In fact, there's a real divergence between stock prices and the earnings potential that they're based on for corporations. When we look at price earnings ratios, they're nearly double the historic average. In fact, financial assets are priced for perfection. Take Tesla, for example. Tesla is priced at a level that it's going to completely monopolize the automobile market for years to come. But Tesla's got a long way to do that. Tesla doesn't make any more cars than we do in the BMW plant in South Carolina alone. And yet it's worth more than Toyota or any other car company. So there's definitely something going on there that is speculative. And you can see that with Buffett's index. Buffett likes to look at the stock market's valuation relative to the size of the economy. And except for just before 2000, we've never seen this higher, that assets are priced higher than GDP. I'm not going to show you that chart. I'd be welcome to share that with you, but that's one I look at. So if you listen to Warren Buffett, you would be buying something besides the traditional stocks that he looks at that have true value going forward. He's been recently buying gold mining, for example. It's very interesting. So we've got speculation going on, and that's being driven by this options trading. Robinhood apps, now people are on their apps, they're trading. They've had a lot of time over the summer to do that. It's easier to do. And what I hear from people who think this market is not overvalued is, oh, this is different. This is what we always say. Oh, it's different this time. It's not a bubble. We also got people chasing momentum. It's called fear of missing out, FOMO. Everybody's feel they're going to miss out, on this stock appreciation. And the fact is, they've got nowhere else to invest. You can put them in bonds. Bonds are paying, 10-year Treasury bond paying less than 1%. I said some people putting money into housing, but or you could hold cash without making any return. But I think the real problem is that people believe the Federal Reserve has our back. This is creating a moral hazard. Everybody believes if the stock market declines like it did before, our central bank is going to step in and save it. This is what I call the Powell policy. Our Federal Reserve chairman at the Fed is filling the punch bowl. Used to be when we had a bubble, the role of the Fed was to remove the punch bowl, to take the punch bowl away. And they do that by raising interest rates, but they're not doing it right now. They're lowering interest rates. They want to prevent sharp sell-offs. They're buying, this is called quantitative easing. They did it after the last economic crisis in 2007 to 2009, buying treasury bonds, mortgage-backed securities, corporate debt. They may even buy index funds right now. They want to prop up these stock markets. They've also got this zero interest rate policy, ZIRP, going committed to low interest rates through 2023. So the Powell policy, do whatever it takes to prop up the financial markets. Here's a chart that shows you what the Federal Reserve has been doing. This is their balance sheet. It's $7 trillion right now. It's hard to get your mind around that, but it went from roughly $4 trillion at the start of the COVID crisis up to $7 trillion in new money creation. When the Federal Reserve buys these assets, they do that magically by just pushing a button on their computer and buying these assets and creating more money, which they can do with we call it printing money, just new money pumped into the system. The size of that is $3 trillion more dollars in this magic money creation, in addition to the stimulus coming from the federal government, the CARES program and so forth, of another roughly $3 trillion. So we have $6 trillion overall in stimulus coming in, $3 trillion in new money, and a lot of that's finding its way into the stock market. A lot of people are worried, oh no, this is going to create inflation. But what's happened is created inflation in assets. This magic money is pushing up the asset prices, homes, but even more so stocks. Just not true for goods and services. We're not seeing inflation in goods and services. It's below the Federal Reserve's target of 2%, and they expect this is going to keep being the same way until 2023. So the Fed's new strategy is don't worry, be happy. We're going to allow this, even if we get above the 2% inflation rate, we're going to keep this easy money policy going. And that, more than anything else, is the reason the stock market continues to boom, because a lot of this money is not ending up in the purchase of goods and services. It's the purchase of wealth assets, especially stocks. So according to the Federal Reserve, okay, we've done everything we can. The next move is, it's up to Washington, it's up to Congress, the president, and then ultimately the Treasury to spend that money, and that's what we call fiscal stimulus. And more massive government spending is probably on the way. And the difference between what the Federal Reserve does with creating new money and pumping that liquidity into the system is this government spending coming from Congress and from the president's approval can direct the money with greater precision than the central bank. When the central bank does this, it ends up in the stock market. But when the federal government does it, it can be directed, like the cash that's directed to households and businesses that really need it, like we had with the stimulus checks and other aspects of the CARES Act that we saw last spring. The problem is, and as Professor Oldendick I was alluding to before, we're now facing a really uncertain election period, and we've got gridlock in Washington. Unlike March, we don't have a consensus anymore. Here I just give you sort of a review of what's happened as we try to get a new stimulus program going here. The Democrats proposed something called the HEROES Act back in May, another round of stimulus, about $3.4 trillion. Republicans opposed this. Then Republicans came back with what they call the HEALS Act. They want $1 trillion more in stimulus. Remember that we had $3 trillion before overall, 2.3 trillion in the CARES Act plus extra stimulus coming in from the federal government during the spring. So the Democrats are compromising a little bit. Yesterday, Speaker Pelosi announced an offer of $2.2 trillion. They want to restore $600 weekly job benefits, another direct payment to Americans of $1,200. You can read all the details. The Paycheck Protection Program will be expanded with small business loans. Also, aid for airlines, restaurants, and other parts of the economy that have been suffering, including child care, performance centers, and so forth. But Republicans are resisting this, so we might not get this kind of stimulus going forward. They believe the economy is healing. And the recent Republican caucus in the House, is the Problem Solvers Caucus, has proposed a $1.5 trillion proposal. So we're going to get maybe, hopefully, a compromise going soon, but there's so much uncertainty and potential gridlock. We can't say that for sure, but everything about the future outlook depends on this. Now tonight we have the big debate coming up. First debate, very exciting. We'll see what happens. Here's Biden's proposal. In the interest of time, I won't go through all this, but in addition to this, maybe $1 to $2 trillion more in stimulus, and just to give perspective, our overall economy is about $20.5 trillion. But in addition to a new round of stimulus of $1 to $2 trillion more, which will help a lot, keep our recovery going, Biden's proposing an extra $7 trillion. You can read the kinds of things you probably heard about that he wants to put in that package. Also some tax increases of about $4 trillion he's proposing. And that's going to be debated tonight. It's going to be very interesting to hear how Trump reacts to that. Now, there's going to be a concern as we continue to see this government spending in the trillions continue on into 2020 into 2021. We're going to see the deficit continue to grow. The federal deficit has tripled since March. It's up to, as a result of the spending, $3 trillion additionally. That's just the addition to our overall debt, which is now at $21 trillion. As a share of output, it's 100%, compared to just 79% last year. That's the highest we've seen since 1946. I know there's a lot of concern about this, that we're just exploding the debt, and this is unsustainable, the federal debt. So should we worry about this $21 trillion in federal debt? Well, this is what the next president's going to face, a very high level of overall public debt. But this growing debt that we have, this $21 trillion, is actually being serviced at falling costs. You know that our debt service actually is falling. It fell 12% last year. In other words, what we have to spend out of the Treasury to service this debt is lower, even though the overall amount of debt is growing. And this is as a result of interest rates at historic lows. They're down the 10-year Treasury at about 1.7%. That's the average interest rate on our debt. So with a new president coming in, there's definitely room to push more spending and more stimulus because the servicing of this debt is actually declining. So should we worry? Now, who holds this $20 trillion in federal debt? Most of it we owe to ourselves. When the federal government creates more debt, it also creates an asset that private sector holds. Well, not just the private sector. Actually, the biggest holder of our debt right now is the Federal Reserve. Their holdings as a result of their buying assets, which is the way in which they print money or create money. They're buying of assets, they're holding these assets. They're the biggest holder right now. I'm not sure why we even have to pay them back. In fact, sometimes we don't have to. We could cancel that. We owe them about $4.4 trillion in debt. But that's owed to the Federal Reserve, and they don't even need the money. The concern should be about the foreign ownership, which is very high. About $7 trillion out of the $20 trillion, about 1/3 is owned by foreigners. The biggest being Japan. The second is China with $1.1 trillion, although China is right now in the process of cutting their overall exposure to US debt. China needs to buy our treasury bonds and our treasury securities, part of this $20 trillion in debt. That holds that because that depreciates their currency. They don't want to see their currency rise. So there's only so much cutting they can do. They have been cutting a little bit recently, and as a result of that, we've seen their currency has weakened a little, or strengthened a little bit. They don't want that. A lot of countries want to buy our debt. So I just want to conclude by saying the good news, we should be happy despite all the problems that we face right now. Going forward, no one else in the world has what I call the American privilege, has the dollar. This is a major competitive advantage right now. We can continue to have an exploding amount of federal debt and Federal Reserve money creation to the tune of the last year, $6 trillion. This is a competitive advantage no other country can do because people want to hold dollars. It's a safe haven in this global economic storm. It's the world's reserve currency. Everybody's holding this as a reserve. It's gold these days, 60% plus of all reserves held by central banks around the world are in dollars. So this big, and most transactions are conducted in dollars. So we're lucky that we are the ones that have the dollars and it can print more and people want to hold them. That's what can keep this expansion of the federal government through fiscal and monetary policy going into 2021. Huge advantage for us. So just to conclude before I turn it over to Professor Von Netschen to give you this, I'm giving you this overview of what I've seen happening with government policy and how important it is. The fact remains that we still have significant pandemic headwinds, and this uncertainty continues to cloud the outlook. We've had a huge victory for Wall Street, and that's because the central bank in the midst of this uncertainty has created certainty. They've got the Wall Street's back. They've got the back of the financial markets right now, and they are very clear that they're going to remain committed to this. It's a bit of a moral hazard because then people don't worry that there's going to be a major correction in the market. That's why the stock market keeps doing well. But I believe the stock market's overvalued absent a COVID-19 vaccine and any fundamental basis, and we can talk about that more in the question and answer period. On the other hand, we got a very wobbly economy for Main Street. We've still got significant levels of joblessness, foreclosures, and that's not even over because, as you know, with a lot of foreclosures, this is in housing, it's been forestalled until 2021, so more could be coming. And it's the same with business failure. So it's going to be a W-shaped, very wobbly economy going into 2021. I think we'll get out of this. Well, if we can get Washington to put in more stimulus, I think we can continue to keep on that trajectory I showed you before to get back to where we were just a year ago, hopefully move towards full employment. But we need this government super stimulus. We've had $6 trillion so far, $1 to $2 trillion more on the way. That's what's going to determine the road to recovery. Now I'd like to turn it over to Dr. Joey Von Netschen, who's going to talk about how everything's playing out in South Carolina and our economy right here at home. Thank you very much.
All right, well, good afternoon, everyone. Once again, my name is Joey Von Netschen. I'm a research economist here in the Moore School, and as Dr. Woodward alluded to, I'm going to be talking about South Carolina's economy for the next few minutes this afternoon and how some of these national trends are influencing what we can expect for our state, both for the rest of this year and into 2021.
Joey, if I can just say one thing, we're
Sure.
going to have time for question and answers. We're going to go over, to 1:30.
Yes, yes. So please stick around. We'll be around for Q&A after the conclusion of my comments. So if we think about this question more broadly of how South Carolina is doing, there are two ways I want to answer that question this afternoon. Number one, I want to spend a little bit of time talking about the recovery that South Carolina has seen so far this year, what the recovery has looked like from April when the economy began to reopen up until September, where we are now. And then we'll talk about the future, where we're headed for the rest of 2020 and into 2021. So first of all, let's just put South Carolina in perspective more broadly with respect to other US states. If we look at South Carolina job losses between March and April of 2020, during the shutdown, we lost about 12.6% of the total employment base in South Carolina. That translates to about 276,000 jobs statewide. And you can see that that puts us right in the middle of the pack when we compare South Carolina job losses to all other states. We're literally at number 25, so right there in the middle. And the states that have done better or worse managing this downturn, particularly during the shutdown, was basically based on what industry composition that largely forms those economies. So every state is different. Obviously, you can see Michigan, number 1. We have Hawaii and Vermont at number 2 and 3 there as well. So largely focused on manufacturing and particularly tourism when we look at Hawaii, for example. So different states see different levels of impacts between March and April. Now, if we look at South Carolina and examine which industries were hardest hit here, again, where did those 276,000 jobs come from? Where were those lost? You can see that it was from all over. This graph shows us a broad picture and a broad snapshot of where the job losses occurred. The red bars here represent changes in employment in South Carolina between April of 2019 and April of 2020. And so you can see that this was broad-based, affecting every industry, most notably leisure and hospitality, which really stands out there, but not the only sector. So the leisure and hospitality was hit hardest, but manufacturing was hit hard as well. It ranked number 2 overall, and then number 3 in terms of hardest hit sectors was healthcare services, which sometimes is a bit of a surprise. But when we think about all the non-emergency healthcare related services that are available, those were largely postponed because of the need to social distance and restrict in-person interaction. So a lot of non-emergency surgeries, physical therapy, dental care, those types of services were shut down as well. So healthcare was dramatically affected in the shutdown as well. Also notice from this slide that if you compare the red bars to the blue bars, we see significant improvement that has occurred throughout the summer months. So if we look at the blue bar here, the blue bars across sectors, that represents employment changes from August of 2020, the latest data that we have available today, and compares that to August of 2019. So across the board, for the most part, we still see industries that are not performing as well as they did in 2019, but we also see marked improvement pretty much across the board. And again, to focus on leisure and hospitality, to pick on them one more time, we saw a decline in employment in April in leisure and hospitality of 50%, 50% between April of 2019 and April 2020. But as of August, it's only down about 20% year over year. So still obviously hurting, but a considerable improvement from what we saw back in March and April. Now, what does that process look like? How have we been able to measure the improvement and recovery since April, since the economy began opening? One way to do that, of course, is to look at unemployment rates. Dr. Woodward showed a couple of these numbers at the US level, but we can also focus on what's been happening in South Carolina. So you can see unemployment in South Carolina, 3.2% in March, actually down to 2.5% back in February, but then the big jump between March and April to 12.8%, and then it's now fallen to 6.3% as of August, our most recent data. And I'm going to talk a little bit about why I think that unemployment rate is a bit optimistic and is unrealistically optimistic as a portrayal of the labor market. But the numbers themselves are not necessarily the most important aspect of this chart. It's more about the direction. And clearly, we've seen a significant and steady movement in a positive direction towards lower unemployment as the labor market has rebounded, as people have gone back to work in South Carolina, as we see this recovery move forward throughout the spring and summer months. We can also look at where South Carolina stands today regionally, if we look at the county level. So again, 6.3% unemployment is where we stand as of August of 2020. And this map breaks down the unemployment rate at the county level. So you can get a sense of what the distribution looks like across the state. And perhaps surprisingly, this map actually doesn't look that too dissimilar from a heat map that we would be able to show you in more normal economic times. So the relative unemployment rates are similar to what we would see in a normal period of economic expansion, with the major exception being the coastal region of South Carolina. So if you look at Charleston and you look at Myrtle Beach, clearly you see higher rates of unemployment here, and that's because those two sectors have, or those two regions have a higher percentage of their economies are in the leisure and hospitality and tourism sector, which, as we've already seen, was disproportionately affected. So broadly speaking, unemployment is still fairly compatible and still fairly consistent with what we're used to seeing historically, with this obvious exception. Now, if we look at the specifics in terms of the recovery, in terms of the job numbers, what do the job numbers actually tell us when we look at the recovery, and how far have we come? Well, we can actually compare directly the job losses that we experienced between March and April. I mentioned before, it was about 276,000. You can see the exact numbers here. And we can just compare those losses to the gains that we have seen in the 5 months since then, from April to August. And just doing a straight comparison, you can see that we've recovered about 62% of the jobs that we lost during the shutdown between March and April. About 62%, and that's compared to about 51% for the national average. So South Carolina overall has been doing much better than the US as a whole. And this is direct evidence for what we've been hearing about as a V-shaped recovery pattern, right? A sharp drop off in economic activity, a sharp contraction, followed by a sharp rebound. We see that very clearly here because it took us about 5 months to regain 62% of our jobs that we lost between March and April. And we can compare that to the Great Recession, where, as Dr. Woodward showed earlier, it took us in South Carolina about 5 years to recover 100% of the jobs that we lost in the aftermath of the financial crisis of 2008. So the duration overall looks to be very different. It's shaping up to be very different from what we've seen previously, and certainly in the Great Recession. So a V-shaped recovery pattern is absolutely what South Carolina has been seeing, at least during the spring and the early part of the summer. However, in more recent months, our recovery pace has also slowed down. So we have transitioned from that V-shaped recovery pattern to more of a U-shaped recovery pattern, which is where we are now. A U-shape defined as more slow and steady growth, as opposed to a more like a rocket ship, right? Bouncing up or lifting off from a major decline. And we can see that very clearly here if we look at total cumulative job growth since April. Focus on the green line for just a moment, and you can see a big kink here when we just look at how the job gains have been accumulating, and the kink occurs between June and July. And so as that job growth settles down a bit, that is the transition from the V to the U-shaped recovery pattern on display. Notice also that it's not by any means restricted to South Carolina. We're seeing that at the national level. You can see a kink there in orange. You see the US, as well as other southeastern states. South Carolina has actually been faring fairly well, not only with respect to the US in terms of our jobs recovery so far, but also to many southeastern states. Not all, but many, including our neighbors, North Carolina and Georgia. But regardless, you can see the very clear transition from a V-shaped recovery pattern to a U-shaped recovery pattern in the midsummer months. One other way that we can observe this is to look at South Carolina unemployment insurance claims data. This gives us a snapshot of what the total unemployment picture looks like in South Carolina, allows us to look at week-to-week trends. The nice thing about the unemployment insurance claims data is that they come out on a weekly basis. So they're much more of a real-time metric of what's happening with the labor market in South Carolina. So I draw your attention first to the left side of your screen with the continued claims data, which is a representation of all unemployed claimants in South Carolina. You can see how that clearly spiked back in late April and early May, but it started coming down at a fairly aggressive rate early on, again, early on during the summer months. But beginning in the June-July period, it flattened out, showing that there were fewer people moving off of unemployment in South Carolina as the job recovery slowed down, as the overall economic recovery slowed down. So that shows us a transition from a V to a U shape. But then you look at that graph and you also say, well, what about the right side of that black line there? Clearly a huge drop-off occurred beginning in August. That must mean something positive as well. But it turns out that's not quite the case. So I use the black bars on both graphs here to illustrate August 1st. And there's a specific reason for that. And that's because in South Carolina, you can claim state-level unemployment insurance benefits for 20 weeks, for a total of 20 weeks, after which you move off of state benefits. And because of the CARES Act, there is now federal assistance that allows people who are still unemployed after 20 weeks to move on to pandemic emergency unemployment. And that's what the PEUC claims on the right side of your screen represents. So essentially, that 20 weeks was starting to pass for more and more unemployed workers beginning in the early August period. If we think back 20 weeks before that, That's right in the March and April timeframe, depending on the individual, of course. So what you're seeing is many people who are moving from state level benefits to federal benefits in terms of the pandemic emergency unemployment claims. So we have to be very careful with using the continued claims data. We have to look at a broader, more aggregate picture. And what we're seeing, again, evidence of a movement from a V to a U-shaped recovery, but nevertheless, the job market is still improving, just not nearly at the rate that it was in the early part of the summer. So briefly, why did we see that slowdown in the summer months, particularly in July? A couple of different reasons. Number one, we saw a spike in new COVID cases in July in the aftermath or right after the July 4th holiday, where we saw a lot of uptick in social interactions and resumptions of more normal social activities. And that led to responses on the part of the public, on the part of businesses reacting to that, and with respect to policy as well. You may recall that Governor McMaster initiated a restriction on alcohol sales after 11 p.m. You may remember reading about that this summer. That occurred on July 11th, and that was one of the responses to these increase in cases. So it had some practical consequences. And then secondly, and also very important, is the PPP fund exhaustion that's emerging among businesses. So as businesses early on during the shutdown and during the early reopening of the economy were facing financial constraints, they were able to receive PPP funds to help them weather the economic reality that they were facing. But those funds now are beginning to be exhausted by these businesses. And so they're having to rely now more on market demand and exclusively on market demand. In some cases, they're able to do that successfully, but in others, they're now having to lay workers off or cut back on activity that they didn't have to worry about just yet because they had that PPP fund cushion. So as that becomes more and more of a reality in South Carolina, that's also slowing down the overall pace of recovery. And then finally, there are simply upper limits on some business activity in the short run. Businesses have to adjust. They do that over time, but when a situation like social distancing and the requirements associated with that go into play, and you see demand profoundly affected in your business, that requires time to adjust. And so there are just some upper limits on what businesses are able to do in a short period of time. Now, looking forward, there are a couple of scenarios that we want to also be looking at to assess whether or not the U-shaped recovery pattern will continue or whether we'll see improvement or worsening between now and the end of the year. And just very briefly, I want to talk about a few scenarios that we need to be considering and tracking. The first is the changing impacts, as you see here, virtual schooling to the labor force. And how is that impacting the labor force? What we saw in August for the first time since the recovery began back in April was an actual decline in the size of the labor force. So as the economy began recovering, as more people were looking to go back to work, in a normal recovery period, we typically see the labor force rise consistently over time. And that was happening in South Carolina as well. But then it contracted significantly in August. And there's a pretty straightforward reason for that. And that's because kids went back to school. And there are a lot of parents who, because of virtual schooling, are having to stay home in order to monitor their kids and to oversee that. And so that's impacting their ability to work. It's impacting labor productivity, and also it's impacting the size of the labor force. And I mentioned before that the unemployment rate in South Carolina of 6.3%, I think, is a bit overly optimistic. If we were to, if the labor force had remained the same size from July to August, and we calculate the unemployment rate, it would actually be closer to 8%. It would be just over 8%. So 2/3 of that unemployment, or a majority of the unemployment reduction between July and August was a result of that decline in the labor force. So again, that's having a significant effect on the ability for the labor market to recover, which is affecting businesses across the board. We also, of course, are monitoring possible increases in COVID cases. I won't spend too much time on this. This just exacerbates the uncertainty that Dr. Woodward has talked about already, and of course, how a potential vaccine could potentially mitigate those effects. And then the additional targeted fiscal stimulus from Congress. What's that going to look like, and when would that actually be put into play? All right, so now let's talk a little bit more about what's going to happen beyond 2020. I want to talk a little bit about the recovery process and the pace of recovery and what we can expect going forward and what we can be on the lookout for. So the first thing is just to reiterate we've seen this graph already, but just to reiterate the lengthy period that the recovery saw in the aftermath of the Great Recession. So it took us, I mentioned, 5 years to get back to full employment, but 7 years if you actually count the starting point as the peak month. So right before the Great Recession began. It took us about 7 years to get back to full employment. So obviously a much faster pace in South Carolina this time around so far, 62% recovery to date. But that leads us to the next question of what can we anticipate going forward? And we have several different scenarios that we have outlined based on what we anticipate as possible realistic employment recovery scenarios, depending on how these different uncertainties play out that we've talked about all afternoon today. So we have more optimistic and more pessimistic scenarios, as you can see here, ranging from red to yellow to green, the color combinations there. And we've also listed out here when we would see full employment recovery, that is employment back to the level that it was at in March of 2020, depending on the different recovery rates that we may see. Now, obviously, there's some variation here. We're anticipating that 2021 will be the year of recovery, where we'll evaluate and really see what long-run growth rate comes into play. But I'm fairly optimistic in the sense that right now, even if we look at the worst case scenario in terms of what our projected recovery looks like, in terms of, from an employment perspective, it still looks to be significantly faster recovery than what we experienced in the aftermath of the Great Recession. Again, December 2022, obviously a long way away. A lot could happen between now and then. And that is nevertheless a very significant period to get back to these employment levels we were at in March and in February and March. But keeping it in broader perspective, it's still much faster than what we saw in the aftermath of 2008 as part of the Great Recession. We can also look at this from an industry level perspective, just to get a feel for which regions in South Carolina are likely to recover at faster or slower rates. Obviously, the way to do that is to look at the industry composition in those regions, right? So we want to see which industries are driving the economy in different regions of South Carolina the most, and then look at what the pace of recovery of those industries are likely to be. So this gives us a sampling of the major industries in South Carolina, the current industry size as a percentage of pre-pandemic employment levels. And once again, leisure and hospitality really sticks out as the aberration here, currently at 81% of its pre-pandemic employment levels. So if we look back to where leisure and hospitality was in March, today it's at 81% of those employment levels. So that's a significant recovery, but still a long way to go. And we can zoom in on the blue bars here to get a better perspective of the percentage of lost jobs that have been recovered so far by industry. Now, these are the percentages that are analogous to the 62% number I shared with you for the state as a whole. So we've recovered 62% of the jobs overall in South Carolina, and you can see how that plays out in different major sectors in South Carolina, in different industry sectors. Three I want to quickly draw your attention to because these are three major sectors just in terms of their sheer size, in terms of the sheer volume of employment. One is manufacturing, where we see recovery of about 86% so far. So manufacturing has largely stabilized in South Carolina. That's good news for Charleston and especially for Greenville-Spartanburg. We also see retail, another major industry sector, just in terms of the total number of jobs that it supports in South Carolina, right in line with the overall state average, about 63%. But one major exception here, when we look at large industry sectors, is looking at government on the right side of your screen there. Government is one of the largest sectors in South Carolina, and you can see that just 23% of the jobs have been recovered that were lost between March and April. And the reason I draw your attention to that is because as we look ahead to 2021, as the government looks like it is taking longer than many sectors to recover, couple that with the knowledge that the tax base in South Carolina has also shrunk in 2020. And that means that regions of South Carolina that are more concentrated within the public sector are more likely to face a challenge when going into 2021, more likely to recover at a fairly sluggish rate. And Columbia fits that bill perfectly. So if we look at the Midlands region, Columbia in particular, right now we are expecting that Columbia will likely grow or recover at a much slower pace in 2021 when compared to other major MSAs in South Carolina, especially when we compare Columbia and the Midlands to Charleston and to Greenville, Spartanburg. So that's going to be something very important to keep in mind for the Midlands region going forward. Now, just as we have an uneven recovery industry-wise, we can also think about an uneven recovery from a labor market perspective. And this is one other point that I want to follow on with respect to Dr. Woodward's comments, talking about the divergent recovery and where we're able to observe it. We can clearly observe it when we look at the labor market and focus on the difference between the recovery of higher wage, higher skilled jobs versus lower wage, lower skilled jobs. And the real dividing line there when we're looking at these two segments is, does a given job require some form of post-secondary education or some form of higher education beyond high school? And if the answer is yes, then they tend to fall in the higher wage, higher skilled category. If the answer is no, then they tend not to. So that's a rough way to break down these patterns, but we can very clearly see that employment growth has rebounded very differently depending on the group that we're looking at. So this just gives you a very specific example. You can see that cumulative, or rather cumulative employment growth from January year to date, so not starting in March, but going back to January, you can see that employment growth is actually up for these higher wage, higher skilled workers by close to 4%, comparing that to the lower skilled, lower wage workers, where it's down more than 10%. So a significant spread there and a significant divide that is more significant in this particular recession than it has been in recent previous recessions, certainly when we compare it to 2008. We can also see this not only looking at employment growth over time this year, but we can also look at it if we examine demographically, if we look at household income levels and look at surveys that look at employment-based income losses by household income level. You can see that as you move up and down this chart, when we get to households earning lower in the lower income levels, you see they are more likely to have experienced a loss related to employment-based income, and they're more likely to expect a future loss. And again, in South Carolina, this points to the fact that the losses as a result of the pandemic were disproportionately in leisure and hospitality, which typically we see where we see lower income jobs relative to the state average. So very consistent when we look at these different metrics and examining these differences. One other way to very clearly see this difference comparing the current recession to what we saw in 2008 is just to look at the average annual wage of all jobs that were lost in South Carolina. And you can see the difference is very clear here. So in the Great Recession, the average job that was lost in South Carolina in the aftermath paid about $48,000 a year compared to just $33,000 in 2020 when we look at the average across all jobs lost between March and April of this year. So a very significant difference there in terms of where the effects of this pandemic have been primarily concentrated. And this affects many industries, and it particularly affects what we need to be thinking about in terms of forecasting for a particular company or for a particular industry. So if you, with your company or your industry that you're most concentrated on right now, you have to think about your customer base and which category do they fit into? Because that's going to be key to assessing the pace of recovery. And a very clear example of one way to think about this phenomenon at an industry level is to go back to the housing market that Dr. Woodward was talking about earlier. If we look at new single-family home sales, clearly there was an effect of resulting from the pandemic, of the government shutdown. But new single-family home sales have done very well, as you can see, at high levels, at their highest levels in the last several years. That's also true for existing single-family homes as well. And so the obvious question is, isn't it inconsistent that we have high unemployment when we have a strong housing market, given that in general, when we look at housing demand, the single best predictor that we have for housing demand is job growth? But the answer is no. And the reason is because in this case, it's different. We see that this pandemic has adversely impacted more lower wage, lower income workers, and they tend to be more likely to be renters. So the customer base for these builders and for these real estate agents tends to be with the higher income, higher skilled workforce. And as a result, you can see relatively higher unemployment that is perfectly compatible with a strong housing market. So we have to think that way across all industries. How are these recovery patterns affecting different industries based on how it's affecting their customers? So just briefly wrapping up then, 4 final points here. The bottom line, the pace of our recovery has slowed considerably since July, as we've showed, moving from a V-shaped to a U-shaped recovery pattern, which is where we are as of September of 2020. And we anticipate that this U-shaped recovery pattern is likely to persist throughout the fall. We are not anticipating that we'll get back to full employment, that is a full recovery to employment that to an employment level we were at back in March of this year, until at the earliest, the midsummer of 2021. A more pessimistic scenario places that in 2022. But again, regardless of what the specific outcome is, it looks likely that our pace of recovery and the length of time for this recovery will far outpace in a positive way what we saw following the Great Recession. We'll see a much faster recovery overall. To date, the recovery been very uneven. As we said, educational attainment, a strong dividing line here in terms of which industry sectors and based on which occupations are in highest demand. This is a way that we can think about how the recovery has been divided out. And of course, that's going to have implications for recovery in different businesses and in different industries. Where is the customer base? Who are they? What do their backgrounds look like? That's going to help inform us in terms of looking to what the recovery will be like for these different businesses and helping to forecast industry growth and specific business growth. And then finally, I want to simply make the point that South Carolina is still very well positioned looking ahead in the next decade. Obviously, 2020 has been a rough year for everyone, but I think 2020 illustrates a rocky period, but South Carolina is still very well positioned for what I call a post-pandemic world for the next decade. Once we do get to the backside of this pandemic, whenever that happens to be, South Carolina has a number of strong competitive advantages. All of those are still with us. They haven't gone away. And in some cases, we're actually seeing that this pandemic may lead to additional competitive advantages for South Carolina, as Dr. Woodward alluded to before, because South Carolina is a more rural state where we have a lower cost of living, a lot of strong natural amenities, and we have the resources and the advantages that will attract people who have the opportunity to telecommute and work from home. So as that trend persists, particularly if it becomes a permanent trend, South Carolina may benefit from that significantly going forward. So I'm still very bullish on South Carolina over the next decade, even as the next year obviously will continue to be very rocky. So I will stop there. Thank you very much for your attention. And I think I'm going to turn it back over to Jan now, who's going to facilitate our Q&A session.
Thank you to all of our panelists for that educational and informative presentation on politics and the national and state economy. There's one thing I'd like to address first. There were a couple of questions about this. I want to state this here.
Jan, if you can hear me, you need to unmute.
I am unmuted.
Yeah, I think we can hear you, Jan.
Okay. All right. Hopefully Doug can hear me now. So the slides and the recording will be published to the Moore School website. All right, so we have questions that I've kind of lined up with the different presentations. So let me start with the questions on politics and the election. And one of those that is to Bob, and that is, what is the predicted impact of third-party voters? So Bob, if we can get him to unmute and show his video. Okay, well let's move on to all right, there he is. Go ahead, Bob. Did you hear the question?
Yes, the impact of third parties. In South Carolina, at the presidential level, contested, I don't think there'll be very much of an impact at all. Particularly if you focus on the Senate race.
Yep.
Have been run by both the two major candidates, and just the amount of resources and money that they have just kind of overwhelm any third-party candidates. So There's certainly going to be maybe some protest votes, 1 or 2% of the votes, but the overall impact on the outcome is going to be minimal.
All right, so one more question for you, Bob, while we have you there, and that was that one of our participants heard that Jamie Harrison recently raised even more money in the last 2 weeks and wondered whether that number was being taken into account in the figures you showed for the campaign funds.
It wasn't in the campaign funds. Those numbers were the Federal Election Commission reports as of June 30th. It'll be there. The third quarter ends tomorrow. Those reports will be released the middle of October, and so we'll have a much better picture of what happened during this current quarter. But certainly all indications are that Jamie Harris has continued to be able to raise large amounts of money during this period.
All right, so let me move on next to Doug. Questions for you. Thank you, Bob. Doug, one of the questions is the level of government stimulus and debt sustainable? And are we nearing a period of incredible inflation?
We're not nearing that period of incredible inflation that everybody's been expecting. It's not going to happen through 2022. We won't see inflation in goods and services. Like I said before, we'll see inflation in asset prices, but not in goods and services, given that the overall level of demand is so significantly down. So right now, inflation is not a concern. I'm not saying after 2022, we shouldn't be concerned about that, because we are pumping so much money into the economy, and if the economy doesn't start growing, that's going to be inflationary. So, you know, the real problem is going to happen if people don't want to hold our dollars. Right now, we've been in this privileged position that we can pump more dollars into the economy, but there's a demand for them here and around the world. If foreigners no longer want to hold their reserves or their assets in dollars, they can find an alternative, then we're going to have a huge problem, because that's going to be inflationary. People will dump dollars. The dollar could potentially depreciate. That's inflationary. That's a long-term concern we've got to be really worried about. But for any other country who's doing what we're doing would have inflation. It's just not right now happening in the United States, and it won't be the case for the next couple of years. I would anticipate, even with more trillions of dollars being pumped into the economy. But there's no alternative. There's no alternative to the dollar at this point. The euro is the best alternative, but you don't see a rush for people to want to be holding euros or euro-based assets, or the yen, or definitely the Chinese renminbi. So we're just in this privileged position. And I don't anticipate, nor does, by the way, the Federal Reserve and the many good economists that are there, expecting inflation to go above 2%. And in fact, if it does, they expect that to be a good thing. The inflation is going to be in assets, and that's going to continue to be the case. It's going to be in the stock market, and that's in wealth, and in housing.
All right, thank you, Doug. I'm going to send one more question your way here, and that is the level of the government stimulus and debt, sorry, that was the question I asked you. It's another question about the stimulus. Which elements of the further proposed stimulus make the most sense? And is it practical to have a fixed additional unemployment benefit? Go ahead. Yes.
When we looked at what happened, and this was bipartisan in the past, with the CARES Act, that we had this stimulus payment paid to most households, not all, but I think over 90% of households got actual cash. This is close to what we call a universal basic income. Everybody got it, and it worked. I think that's the best way to stimulate the economy. Give people money and let them determine how they want to spend this, or actually they may want to save it. And I think that was a very effective program. Now we need to target other parts of the economy that have been hurting, in particular, like small businesses. We need to keep those programs going as well. We've got many other needs. I wouldn't deny it. But I think from an economic point of view, I don't know if you agree with me, Jan, it's better to give people money and let them make decisions as to how to spend that money, and that work with the stimulus check. So we're probably going to see another stimulus check of $1,200 can be very effective, and then some other targeted programs. One thing though, has to do with the election, and it's going to be a big difference.
there's going to be huge needs for stimulus from the federal government for state and local governments. They're going to face in the fall and going into next year a major fiscal crisis with tax revenues falling off from this year. And there's going to be a big question is if the federal government should be bailing them out. Democrats are tending to be more supportive of that. Republicans are not. But I think that's another area we have to really look at very carefully. Is there going to be money available for state and local governments? It's going to affect us here, obviously. But my general conclusion is another stimulus check is going to be the most effective in keeping our recovery going.
All right, great. So let me send 2 questions to Joey, and then we'll run through additional questions if we have time. Joey, the first question for you is, what can the Midlands do to spur economic growth? We know that typical reasons given as to why it lags. So what recommendations would you have to spur growth for 2021 and beyond?
Well, one of the things that we've talked about before is that we need to focus on better retaining our talent in South Carolina and in Columbia, and using a variety of tools to create a high quality of life and more opportunities for individuals to stay here, for young people to stay here after they graduate. Because if we look at economic development policy going forward, it's typically previously been about recruiting companies to South Carolina and to Columbia, but now we have to think about this new phenomenon of this work from home phenomenon, which is becoming more and more widespread. It may become permanent. And if it does, that means that economic development policy has to not just look at bringing companies into Columbia or into South Carolina, but also more generally at looking at the talent that we have here and matching this talent with companies, whether they're located in South Carolina or Columbia or not. And how can we better do that? And how can we better incentivize individuals to stay here, whether that's, again, promoting the high quality of life that we have, whether it's a number of other initiatives that we look to. But I think that's really the key is focusing on the individuals and matching them up with companies that could be located anywhere in the world or anywhere in the United States, and put as much focus on that as we do on bringing companies in. I think both of those are going to be important in the new environment as we head towards the new decade.
All right, one more for you, Joey, and that is regarding real estate markets. Where do you see real estate markets after 2022, and are you assuming an uptick in foreclosures?
So the short answer is yes. I think we will see an uptick in foreclosures. I don't see a major, a catastrophe there. Certainly like anything akin to what we've seen previously in 2008. But I think more generally, the housing market, at least for the foreseeable future, looks to be strong. As long as unemployment is either at its current level or is continuing to improve, then there will be demand for housing. So that is likely to be the case for markets across South Carolina going forward. And if we, particularly now, again, given that housing demand is strong, given the current employment climate, but in addition to that, we have to look at when we're examining housing markets going forward, we have to look at markets across the state and the reasons for demand, where that's coming from. And so right now, not only are we seeing demand for housing from a relatively a segment of our economy, a segment of the labor market that's continuing to do well, but also as we see these migration patterns that are benefiting and are likely to benefit South Carolina going forward. We're already seeing evidence of this. Builders are stating and real estate agents are stating that they're seeing more customers coming in from outside of South Carolina, and they're also seeing customers, home buyers, that are looking to reorient their lifestyle. So looking more towards home offices, for example, as a more popular floor plan. That's being more of a priority. So again, I think housing demand is looking strong for now, and the final piece of this that we haven't really talked about is inventory levels, which nationally and in South Carolina have been down for years. And this is before the pandemic began. And that was helping to drive housing appreciation. And also it is an integral part of demand. And so that's going to likely be the case going forward as well, at least for the foreseeable future. So I think as long as unemployment remains down, housing markets are going to do well for the foreseeable future.
All right, so I have a question for Doug and Joey, and the question is, are we seeing a national trend in supply chain reshoring and its impact on South Carolina?
Not really. You would think so, and that was a major prediction when we went into the pandemic crisis, that people were, because of the pandemic, people were going to be bringing more supply back. The fact is that China is really bounced back very quickly. They're supplying everything that they were before, and even more so because their economy is performing so well. It's not easy to move that supply out of Asia back to South Carolina. I mean, there's been some talk about that, but we see really no movement in that direction. As long as they can get the supply. In fact, the Port of Charleston is now positioning itself to take even more supply into our state. So it's not disrupted supply chains as we expected it might have happened when the pandemic first happened. And largely it has to do with that nobody else can do what China does. They can't do it easily, and they certainly can't do it quickly. And in this age of uncertainty, to make big investment decisions for suppliers to come into the United States, it's just not happening. So the traditional supply chains are still intact.
And we've seen the supply chain, just to follow up on that, we've seen the supply chain disruptions really go down in recent months, largely because of what's been happening in China, as Dr. Woodward mentioned. But if you follow the surveys of businesses, particularly manufacturers, how are they experiencing supply chain disruptions in any given week? We see that steadily trending downwards, but it's actually higher if you look at supply chain disruptions in domestic markets versus global markets. Again, getting back to the fact that China is doing very well and are sort of ahead of us in the process and really have been for the entire pandemic period in terms of the shutdown followed by the recovery process. So it really depends on where you look internationally and domestically, but there's a divide there, but there's improvement across the board.
Jan, could I just add something to the answers that Joey and Doug put forward? I'm not hearing anything.
Yeah.
Yep. Go ahead, Pete. We can hear you.
Go.
Yeah.
Okay, so I think you should think about supply chain disruptions in two broad categories. The first one is the change in consumption patterns over the last 6 months as a result of COVID, and how some things that were suddenly demand from home that used to be consumed somewhere else, and that created all sorts of imbalances in the short term within our domestic supply chain, some sourced from outside, but some also produced locally. And it's not clear how quickly that's going to unravel or where it will change, and that depends upon the recovery, the vaccine, etc. The second part of this relates to the whole global model that has been in position certainly since the last 50 years of the 20th century, where we made somewhere else and imported here. And America became the consumer of last resort to the global economy. Over time, that will change, but you're not going to see very fast adjustments to that. If that does change, it'll change much more slowly. And we may come back in a decade's time and discover that more has been onshored. But that sort of stuff does not happen in a year. And we'll have to wait and see what happens on that one. There is a third variable that I would introduce for people to be aware of here. China is probably going to turn inward also. Most of its growth historically was through export-led growth. There was not a lot of consumption going on inside China. I expect that to rechange over the next generation or so. And as that happens, it will be in China for China as opposed to in China for somewhere else. What that also means is that we may need to find other ways to manufacture, to produce for ourselves, and the sort of more domestic regionalization of our economy may happen as a result of that. But these are long-term trends that you won't see in 6 months.
All right, we have another question about the housing market. I guess, Joey, what percentage do you think the housing market could fall?
What percentage will it fall? Well, right now, I don't think. I think if we look at if we look at the housing market from supply and the supply side and the demand side, right? So as economists, we can break it down in those two ways pretty straightforwardly. I think on the demand side, things are looking pretty strong. Looking at residential housing, So there, for the reasons I've outlined, I think that markets are going to continue to perform well going into 2021. We do see some potential supply constraints on the horizon to the extent that prices for building materials have gone up, especially for lumber. Lumber prices have just skyrocketed really in the last year or so. And that's becoming an increasing problem and putting upward pressure on costs for builders, which are being passed along to consumers. But in general, if we look at overall demand on the residential side, I think that's going to remain strong going into 2021. Now, if we look at commercial real estate, that's a totally different picture because there we're talking about a complete change in that industry dynamic, given the work from home environment and the need for traditional office space and commercial space is changing very rapidly. We don't know what that's going to look like yet, but they're facing a very different set of challenges than residential housing right now.
Thank you. So Bob, we have a question for you. And the question is, explain how a tie works in the Electoral College. Does the House vote by state, or am I wrong?
That's exactly correct. The election would go to the House of Representatives. Each state would get one vote, and it takes a majority of states to elect someone to the presidency. And as the delegations are currently constituted, the Republicans have a majority in enough states at this point, and they probably will have after the 2020 election, so that if it went to the House, it would look like the Republican candidate, Donald Trump, would win the presidency. So that is exactly how it would work.
All right, thank you, Bob. I have a question for Doug. That is, how much money remains in the CARES Act? Is there a dire need for CARES Act 2, which is currently being discussed by Pelosi and Mnuchin?
Yeah, there's about, as I read it, about $600 billion left out of the $2.3 trillion. There's more money left there that hasn't been spent. I mean, but I don't think that's going to be enough. We need more stimulus, as I said before. I think we're going to get a consensus around something in the order of $1.5 trillion more, because there's still a lot of unmet needs in addition to what's left over from the CARES Act last spring. So yeah, the good news is it's not all spent. Some of it hasn't been spent very wisely, so there needs to be more control over how it's, where it's going and how it's being spent, where the needs really are. But I anticipate maybe even before this election, we're going to see an additional $1 to $2 trillion more added into the $3 trillion we've already pumped in. But there is some left already, not enough.
All right, thank you. One more for Joey and Doug, and that is, will South Carolina see noticeable impacts due to the current exodus from large cities?
Yes, that's something Joey will come back to us in a minute. We talk about a lot. We think we're well positioned competitively to take advantage of this trend. You know, we have some major urban areas around Charlotte, Charleston, Greenville, and Columbia, but they're not the same as they're not facing the same problems that you have in New York and the Bay Area and elsewhere. And I think even as a Moore School, we ought to think about taking advantage of that, because I think there's going to be a lot of demand to work from home, to work remotely. Our graduates could stay here. They don't have to go to these big cities. Our cost of living is lower. And where the shift has been competitively is it used to be, we would say as urban and regional economists, that density was good. You know, we needed more in South Carolina. That shifted so dramatically now, where low density is good. In fact, sprawl is good. People are looking for a big house. They want sprawl, and we have that in our cities. People can get a big house, affordable house, and they look at the price relative to other areas of the region and how much they're going to save and get the space that they want. South Carolina is in a very good position, and I'm sure Joey can amplify my comments on that.
Yeah, I agree completely with that, and I would just add to that we're seeing direct evidence for that. Coming back to housing again, if you talk to builders and talk to real estate agents, they will tell you that they're seeing an uptick in buyers from markets outside of South Carolina looking to come to South Carolina for exactly that reason, looking to get out of these larger cities where the cost of living is higher in the aftermath of the pandemic. And so this is happening already, and it's especially pronounced in Charleston. Obviously, Charleston has a more recognizable brand when you get outside of the Southeast. So we see this trend more so in Charleston than elsewhere, but it's happening across the state, and and so we can see it on the ground in addition to being able to see it in the numbers. So it is happening.
All right, another question for Joey and Doug. How would you factor in our luxury car industry and Boeing issues into South Carolina's economic future?
Okay, I'll start with that. And again, Joey can continue to add to my comments, but very good. You know, the part of the job market is still doing well are the professionals, the high end. Joey was talking about that before. That's true here in South Carolina. Professional jobs are holding up very well. People with higher education, they're the ones that are not losing their job. That's always the case. These are the ones that can afford our luxury vehicles. So BMW, as we understand it, is still doing very well. It's going to be true of Volvo, which has shifted its focus from exporting Volvos outside of South Carolina to the U.S. market, making a version of their SUV, which there's huge demand for. So our auto cluster is in really actually very good shape. We're also, by the way, making Sprinter vans being bought up by Amazon. They're made in North Charleston. All these segments of the auto market are very healthy right now. Now, to go to Boeing, there's going to be a big announcement in October. And I'm hoping the announcement is going to be they're going to shift the Dreamliner production, the 787, entirely to Charleston. So we're going to actually, even though that industry overall is struggling, we might see a big expansion in our job base as they consolidate the Dreamliner production. And that announcement's going to come this month. So we're anticipating that aerospace is going to come back too. So manufacturing is very healthy.
Yeah, I just follow up on that by saying that it really sets us up well for our manufacturing sector driving growth over the next decade. This a potential announcement from Boeing, because we are, we're ready if Boeing makes that decision. South Carolina is ready. We have a strong workforce. We have workforce readiness programs. We have a strong supply chain. So South Carolina can easily integrate that expansion and that consolidation. And that, again, really sets us up well for the next decade to move forward. Because if we look over the last 10 years, that expansion was largely driven by advanced manufacturing, meaning the auto sector, the aero sector, and the tire sector. And there's no reason that can't continue. And Boeing consolidating in North Charleston would be a very positive step in that direction and set us up well for the next 10 years.
All right, well, I think that concludes our questions. So I'm going to turn it back over to Pete or Doug or Joey to conclude. I know we'll be having another session, so hope to see you again.
That's right, Jan, and thanks very much for everybody for participating today. This is our first time doing this in a live format. I hope it went pretty well. I know we went a little bit over. We'll work on the timing of that, but we appreciate your questions and your participation. Yeah, our next event will be with Tom Barkin from the Federal Reserve. And in my remarks, you can see how important I believe Federal Reserve policy is right now. So it's going to be very, very interesting. He's a great speaker, very interesting to hear from him. That's going to be in late November. It's part of our series that we want to keep going. We're going to bring in more and more outside experts so as we can use this virtual format. This is our first time, but I think it went well, and we're going to continue in the future, and we hope to see you all. Thank you very much.